So yeah, first of all, I want to say express my deep appreciation for this event because I was in New York presenting our approach to fundraising with a more regenerative model. And funding the commons was really instrumental for a further improvement to the model itself that actually made it possible for us to raise money with it. And my special appreciation here goes also to Michael Zargam, who was mentioned by Kelsey several times in the call before and the talk before, because his insights were key to these evolutions. So I'm a co-founder of a company where we develop a tool called Memex, and our goal was to figure out a way to raise funding for this software with a more regenerative model that allows us to reduce profit maximization incentives, while at the same time making it more attractive to VCs and generally the classic investment market of angels, VCs, or stock markets. And so what I'm doing here is I'm sharing how we approach this, and hopefully it's useful to some of you, specifically if you're a seed or early stage company with medium to high capital needs, and you want to avoid taking VC money for reasons like, hey, you don't want to have the growth pressure that this type of investment imposes on your company. You might not, as a company, be a good fit for the expectations of having an exit in later stages, or you just don't like to go down that route where profit maximization is on top of your agenda for a long time to come. By the way, the notes are still not here, just saying. So, quick question to you, and you can shout out now. What do you think this curve represents? Just shout it out in the room as loud as you want. Thank you. All right. It has something to do with growth, yes. One last try. All right, I'm going to go ahead. So this is the natural growth of a healthy organism. It's how it grows in its ecosystem. And it's also the natural growth of literally any service or company on the planet, no matter how big they will become. Even behemoths like Facebook and Google will have their natural growth limit. But now the question comes, what is this? Again, you can shout anything. You can probably already guess where this is going.
Famous hockey stick jar.
Yes.
Something that's about to crash.
Also true. Yes, very much. All right. So this is the growth curve of cancer. And essentially, it's an organism that will continue to grow until it kills its host. And it's also the growth expectations that our current economic incentives impose on companies. And if we're now looking at the difference between those curves, this is roughly like expressing the pressure that a company feels to extract, because at some point it will just naturally need to grow beyond its own natural growth limit as the incentives for growth continue to be put on the company's economic drive. And so this means with that, a company also has little to no economic freedom for regenerative behavior, like, for example, internalizing its own externalities or spending money on the commons, because ultimately what that means is every dollar that a company spends on any of those things will directly impact the bottom line of investors. And so ultimately everyone will, over time, maximize for like maximizing their own profits. So what we need, though, is companies where the profit expectations are much more aligned with their natural growth limits. But what we also need is companies that have the capacity to grow big and fast, especially because the reality is they need to be competing on a market where a lot of their competitors will not follow these principles at all. And also, a certain level of growth is, like, if we're realistic, is necessary in order to have the impact that we need to have in order to regenerate the massive amounts of damages that have already occurred in our systems. So we need kind of a mix between a way for a company to be regenerative, but still being interesting for the type of VC investments that they need to get that money, because that's oftentimes, unfortunately, one of the only sources where you can get, say, $1 to $50 million of investments. So if we want to have companies with more economic freedom for regenerative behavior, we need to have economic models that both can promise high returns, but that also ask a key question, which is, how much is enough? And so a really quick context for what we build and how that all fits into this model. Essentially, we're developing a knowledge management software. And in our line of work, the externalities that are created are unlike if you, for example, have a table where the externality is created in the Amazon, where the rainforest is cut down to provide like virgin trees, etc. In the knowledge management space, the externalities, the extraction that companies do when they profit maximize, affects directly users through, for example, things like lock-ins or extractive business models like ads, etc. But on the other hand, a company like us needs to have quite high capital injections over its lifetime, and those resources, it most likely gets only from VC-type investments. And so for us, it was important to figure out a way, how can an investment model still be interesting for VCs, et cetera, but have the capacity to not put the pressure on us to extract ad infinitum, essentially. And a way forward that we found is a performance-based cap on stakeholder returns. And that means essentially that there is a limit on how much investors can extract from a company, while at the same time rewarding outsized success. So it might still be the case that our company has a 50x return for investors over a 10-year life cycle. But after that, there's nothing more that an investor can extract. So the pressure for them to extract, and like for us to extract from our users, will cease after that timeline. And what it also means is that suddenly a company will get more and more economic freedom to do the right thing, which means it has suddenly capital that is extra, that it cannot be claimed by individual investors, team members, or general stakeholders, that then can be used for things like accounting the externalities that the company produces while operating, paying workers better, for example, or what I'm particularly excited about is becoming funders and backers for impact certificates and hypercerts. Because there, the inherent problem is that many of the things that we want to put into impact certificates don't have a direct economic value that we can map towards. So it's very hard to actually get the money into the system that then translates the impact into real-world economic gain for the people who produce the impact in the first place. And if you are interested in reading more about this, there's a couple of people here in the PL community and also in the wider community that do amazing work and have written out a lot of stuff about it. Here are 3 names: Davidat, Kevin, Milwaukee, and Alaborda. I leave it up for a quick second if you want to take I saw someone wanted to take a photo. Good. Cool. Yeah, so that all sounds really rosy and cool, and I like it, but there's a couple of hurdles, and in particular, a cap inherently breaks a VC's math. And that is because a venture capitalist invests in 10 companies, one goes 100x, the rest die, and that's how they return their fund. So if you say, well, if my company will be successful, but it will be capped, then you inherently break the risk-return calculation. So that needs to be solved somehow. And the second problem is that the model itself needs to be as compatible as possible with the way the current legal structure around investing works, but also the way the current sense-making operations work for investors. So how do they invest? How do they think about valuation? How do they think about their returns, et cetera? So the first question that loops into the second hurdle, so I start with that one, is how do we implement the cap? And essentially what we do is we implement it with redeemable equity. And we do this because investors think in equity. Previous implementations of capped return structures often used debt instruments, but those are not really compatible with the way most investors think. And what redeemable equity does is essentially giving our company the right and responsibility to buy back its own shares at a specific time in the future. And that means also that until that time in the future arrives, those investors that invested early have kind of an uncapped return. But afterwards, where the risk also subsides a lot, because the company might already be fully operational, makes a couple of $100 million per year in revenue, the risk is just so much lower that an uncapped return going forward is actually not even reasonable from a risk perspective anymore. And what's also really beautiful about this, by having a redeemable equity structure where the company ultimately needs to pay back its investors over a longer period of time, we can also think about designing our own incentive structure. So how we actually want to value that company. And we can think about many different flavors, and that is really contextual to the company itself too. And here's just an example to illustrate that. What I mean with that, essentially thinking about the company valuation could be 20% of the market cap currently, plus 3x our revenue, plus 2x our profit, and we multiply all of that by how much ecological sustainability we have provided or how much social sustainability we have provided. So we can already from the beginning map out where the company is going and what we want to reward ourselves with by nature of how the payout and the value of the company is determined. And then we think about, okay, how does a company eventually redeem its own equity? It's also a really big question, because ultimately there's no market necessarily anymore that will pay for the current investor's return, how it is now, right? This the latest fool theory, where you essentially have just one more person that is the next one will pay for this. In this case, the latest or the last fool is the company itself. And so there could be, for example, by going through company profits. It could be through venture debt, that at some point when a company makes enough revenue to actually have a high valuation, to also say, hey, we can recapitalize through debt that we can get from banks or from private equity funds, et cetera, that then make sure that the initial investors are paid out earlier. And another one that I'm personally also really excited about is something like a bailout to community. So this is the kind of bailout that I would love to see much more, like instead of big banks that have fucked the economy the whole time, actually thinking about how can we have companies that do good and that are operating with these models, how can we make sure that they, in the shortest amount of time, are without pressure to extract? And that could be, for example, governmental organizations, nonprofit organizations, or philanthropic funds going and saying like, hey, we're backing the buyout or the payback so that the company doesn't need to actually pay as much back to its investors, meaning there's less pressure for the company to actually continue maybe on a semi-extractive path. And it also is an interesting way of thinking about retroactive public funding, because you can really tie the retroactive public funding process to a specific milestone or a success metric that the company achieves, and through that feed into this bailout to community. And what's also really nice about this approach is that you can, if you want to get started with something like that, you can just start with a classic SAFE agreement. If you're familiar with this, Y Combinator has developed this legal agreement a couple of years back that will make it really easy for early stage companies to raise funding from investors, because they don't need to deal with the question of how much is a company valued at a time when this is a very difficult question to answer. And so we actually raised just with a SAFE. And we can continue raising with a SAFE until we do implement the redeemable equity structures. So this means you don't need to reinvent any new legal deals. You just use what's already there. You don't have extra costs for running with this model. And with the SAFE is also really important, you buy yourself a lot of time. Because the SAFE agreement inherently gives no voting rights to investors, which is really important in a situation where you want to yourself still figure out how do we value the company, how do we do the redemption, how are we setting up that legal structure that is a bit more complex than the classic equity agreement, and you don't give investors the power to interfere in that process from a legal point of view. So, but still, we have the problem that the cap inherently breaks the math. And the question for us in this context was, how can we figure out a way to significantly reduce the risk for an investor so that a cap becomes, again, a bit more acceptable? And if you look at this poorly designed chart, it would situate itself probably a bit more between a loan and a VC investment, tilting, or a loan or a bond, and tilting towards the risk return of a VC investment, but with significantly lower risk, but also with lower upside potential. And so that also means that this investment structure, like I mentioned in the beginning, might not be the fit for someone who wants to build the next Facebook. But it might be a good fit for someone that wants to build the next Figma, or even the next Twitter, which is not the huge size of Facebook, but it's a company that needs its 50, maybe even $100 million in investment over its life cycle. That might be doable, or smaller, like up to like 5 million or something like that. But not like hugely capital-intensive businesses, which actually most of the businesses inherently are or want to be, but are forced to go in another growth trajectory just because they took VC money in the first place. So if you look at some of the risk factors that we can address with this model that current VCs have, is one, when they invest in a company, they're usually locked in for a long time. So you're locked in for 7 to 10 years until an exit happens. And that means there's a lot of uncertainty. You have no ability to go out and say, I will save my initial investment or even maybe some small profitability. There is just generally a high risk of the company not succeeding. And then there's in particular also a high failure rate on 10-year time cycle. I mentioned before, like one company succeeding, the rest dies. So about 8 to 10% of companies that are VC funded survive the 10-year mark. What we're going to do in order to reduce that risk is we're going to use a tool called Fairmint. I'm not sure if you're familiar with it. It essentially is not necessarily limited to Fairmint, but what Fairmint provides as a functionality that is really useful to us is it allows us to tokenize these safe agreements. And this means we can sell tradable shares in our company from day one. And this means we can onboard our entire community of investors and users to start investing in a company with a direct legal tie to future equity of the company. And what that does to those 3 different risk factors is essentially, one, because they're tradable shares, you give an investor liquidity immediately. This means if they want to exit, they have a chance. This doesn't mean they can. Obviously, if the company does really poorly, they will probably find less buyers for it, but they could. If the company is actually doing reasonably well, say, for example, the company might be on track to, say, a 15x return on a 10-year time cycle or even more, then someone might sell their shares at year 2 or 3 for a 3x return. And so this means if you can make on a 3-year cycle a 300% return, and you have then break it down to what the yearly returns are, you get roughly, say, 100% return per year, which is much, much more than a VC currently calculates when they're looking at their average return rate, which is usually between 25 to 50% per year per company, averaged out over the entire portfolio. I'm not saying that these numbers will happen, but it gives you a sense of, like, if you have early liquidity, that really buffers out a lot of the need for long-term high upside. The second risk reduction factor with this is if you have an early community buy-in in a product in particular, the chances that this one is very big signals for the investors. Hey, there's actually people backing a product, not just by being customers, but actually by being investors that want to stay in the long term. And you have also, just generally because you have a lot of people backing a project, they will be advocates for the project. They will be advocates for the product. So the chances that this company and this product will survive over mid and long term is also much higher. And lastly, the survival rate is also higher with those companies. So a company that right now is forced to make profits, like an SMB, for example, has about a 4x higher survival rate than a VC company over a 10-year life cycle. And if we're looking at companies that are purpose-oriented, like these kind of cap return funding structures, they have a 6x higher survival rate on the 10-year time cycle. And the reason for that is because they have a higher employee retention, they have a higher purpose alignment, so people actually go in with a lot more juice than they are when they work for, like, at some point, a no-name company, or like not no-name, but like increasingly soulless company as it grows. And in the specific case of this structure, it's because, again, those companies need to make profit. If we're not profitable, if we're not able to repay our own redeemable equity, ultimately no one of us will make more money than our own salary. So we're all forced to make it a profitable company, which means the chances that we're dying if we're a profitable company having implemented services that people use on a daily basis is also just much, much lower. So give a quick recap of the roadmap here, how these domino stones can fall. We start raising with a safe. It's maybe a bit small in this one if you can see it. We start raising with a safe to then basically get our company to a state where we have a solid amount of revenue and a solid user base that then allows us to raise in a more community-based round through the Fairmint raise, where we can include, for example, already impact VCs that are less interested in these super high returns. And the Fairmint raise also allows us to basically back the most risky part of the investment timeline, where we need maybe 2 to 3 million, but those are backed by users who actually want the company as a product to succeed, which means they are much less hungry for high upsides, and impact VCs also, which then allows us to gain a lot more traction and then include VCs, like classic VCs, in probably Series A rounds. And we also recognize that in the first 2 stages, classic VCs will still not be interested, because ultimately a VC's fiduciary responsibility is to maximize the shit out of the assets they have. That's their legal responsibility in front of their LPs. So they will only go in if they can see strong traction and actually, if we make, for example, what's it called? So the evergreen fund of USV Ventures, they expect their Series A fund, they expect like a 2 to 3x return on an investment over a 10-year time cycle. So this means we're already reduced the expected returns at that point from a potential 100x return to a 2 to 3x return. And so this means this is a more viable point for them to enter an investment. And the last step is then the equity redemption, although that's right now not really clear when exactly that happens. And this is also part of this ongoing research that we're going to have in the next 2 years or so, is to actually figure out how is the exact redemption process going to work, how we're going to value the company, and how can we make that case and legal structures for that Fairmint raise really solid. And luckily, we got also a €150,000 grant from the EU for doing that research. So all the legal research around it, all the tax research around it, and open sourcing all of the contracts and of the legal agreements that we develop in the process. So that's for everyone to use, obviously. If you're interested in being up to date with that research, you can follow me on Twitter. That's probably the place where I start posting the most. There also will add, once we have a blog where we actually properly post and publish all of these, the research output, you will know there at first, essentially. And wait, is that the last slide? Oh, no, here. And here you see, it's a bit low. My Twitter handle is @BlackForestBoy with an I at the end. Or you can find me, you can just write me an email at ollie@memex.garden, OLI. Yeah, hit me up if you're interested to both be up to date, but also if you're really interested in having joining the conversation and the dialogue to figure out how we value companies in a more sustainable way. Yeah, thank you so much. I would open it now for Q&As if anyone has questions. And yeah, thanks for being here. I think the microphone is coming to you.
Really small question. Who are you raising with on the very first saves?
Actually, Protocol Labs was one of our bigger investors in this round, and a couple of angels.
Okay, so not really big VCs, more partners, people that are going to participate in your growth.
Yes, exactly. So that's also the stage in which we're in right now, is to first raise from a very aligned group of angels and organizations, partner organizations, and then going to a community that is our user base, and then going to like more like either impact VCs and then later on like classic VCs.
Awesome. Thanks.
Dum, 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 dum.
I'm wondering if you've given much consideration to the regenerative nature of the investments as well, and I've spent a bit of time thinking about this. And when I say regenerative, it's a little bit like how different startups have formed their own mafia post-exit, and that has basically created entire ecosystems that have allowed organizations and individuals to be funded. Do you think there's maybe a mechanism for this model to actually support more of the individuals rather than the organizations?
Mm-hmm. So in my personal like value system, I would like to like this economic freedom for regeneration, because individuals cannot infinitely claim profits. It's also a much more optimized for a win-win scenario. So ultimately, if this becomes a really big and successful company, I'd rather be in a system where there's 200 people that are all multimillionaires instead of 1 billionaire in the system, or like 2 or 3 founders that are becoming billionaires, and through that become a much more distributed mafia, essentially, of people that hopefully are more aligned and have the capacity and the capital to collaborate on a much wider scale than now. Like if you think about PayPal Mafia, where 5 people obviously created a huge ecosystem around it with like huge impact in the world, but it was eventually just 5 people who made the most cash out of it. Sure. I think that the question is, where is the trade-off? In the end, if you say, if this is a $1 billion company at some point, I don't know, like if the company has then a $200 million fund,
Yeah.
and that $200 million fund is coordinated with a bigger group of people for regenerative purposes. It's just the opportunities there, because that fund cannot be claimed by individuals anymore, so it has more freedom to be chosen for, we can do lots of other things now without lowering the expected returns of the stakeholders anymore. And that is what that should do. I don't know what the actual implementation or the actual regenerative functions will vary from company to company, but ultimately the key word for me is always economic freedom to make these decisions. So I don't have a concrete answer how we want to do it either.
Yeah, no, I understand. And the other aspect that I've been exploring is within the investments, how do you actually support the entire ecosystem as well? So you might be funding 1 or 2 projects, but even the failures of projects create great insight for other projects to emerge out of the ashes of them in many instances as well. So how can we be making investments that, again, support an entire ecosystem rather than putting a bet on one horse?
A valid question, probably a bit out of scope of that particular structure. What a question that came up in these conversations often is like, how can investment structures address entire classes of tools or classes of like services? Like, for example, you invest in a personal knowledge management space where there's many companies that benefit from it that may operate with these models or similar, and have a kind of a resource sharing economy internally going that regenerates its own commons as they go.
Yeah. I think it's a very interesting and innovative idea to cap returns. Of course, I suppose what you don't really want to cap returns so much as prevent the thing growing into a monster later on, and as often seems to happen, as you say, there's a pressure to extract and make more profit. One of the reasons, as far as I can see, that things do kind of grow into monsters, when companies get very big and profitable, they start to get sort of monopolistic power, and they sort of, everything they do is sort of try to hold on to their power, then they become incredibly profitable because they can crush their competitors. And one famous example, no doubt you've heard about this, is probably the kind of archetypal example which was Standard Oil in the early 20th century. They were broken up into albeit extremely giant oil companies. I think there was about 4, kind of Exxon and several others. So I was just wondering if that there are other techniques or approaches you might have explored to stop this monstrous growth, other than capping returns, perhaps. A company being automatically broken up once it passes a certain amount of returns, perhaps could prevent this sort of monopolistic, metastasis into this sort of, kind of world spanning octopus. I mean, I was just wondering if there's other mechanisms that you had considered.
I mean, besides looking at what's already there, like, for example, things like breaking up companies or figuring out how to have regulatory tax burden on companies that become super big. The problem with those I see always is, like, it's a cat and mouse game, because as soon as the individual person's incentives are, I can maximize, they will find ways around it all the time. And so that was the rationale behind this. And also thinking about, well, how can we still make it kind of compatible with the slot machine, gamey nature of capitalism by saying at least the cap is a performance-oriented, which means the first 10 years of investors kind of get an uncapped return, but then afterwards, where the risk is just so much lower, it should not happen anymore. And so up to that point, you've gotten probably pretty rich at that point, to justify the risk that you've taken, and then it's probably also fine.
I see what you mean. It needs to be a mechanism that's maximally hard to sort of game or do something else. Or
yes.
Yeah, or it could be a time limit, I suppose, is another way. But then, yeah, some companies take longer to become profitable than others. So
yes, and it needs to be adaptable. Like, for example, that's why we have now these 2 years of work ahead of us to figure out what's our first formula before we do that public launch with the Fairmint raise. We want to have that formula, so we know what's suitable as a formula for our company, that we can reasonably provide those profits, but also reasonably pay them back. Because if we make that formula to get us like massive returns and then it takes us 40 years to pay back, then we have 40 years of still the pressure to extract, right? So it's like, how do we ease the pressure as much as possible as the company grows older?
I see. That's interesting. Thank you.
Cool. Thank you so much.